Share Predictions offer a dividend tracker where you can follow which companies are about to pay dividend in the near future. These companies are grouped based on their ex-dividend dates, which you primarily should be following to be eligible for the upcoming dividend payment. You must purchase your shares before the ex-dividend date and must be holding them when the market opens on this date to be able to get the upcoming dividend payment. And for each ticker, we also provide lots of information, and today we'll be talking about the dividend yield. While I explain what dividend yield is, I'll be browsing through different sections of the dividend tracker so you can get a feeling about how it looks as well. But let's first define what dividend is. It's basically the distribution of a company's earnings to its shareholders and is determined by the company's board of directors. With other words, companies share some of their earnings with their shareholders by paying dividends, and often in the form of money. Generally speaking, growth companies tend not to pay dividends, or even if they do, they in general do not necessarily pay high amounts and instead try to reinvest their earnings to make their company grow more. And if things go well, the price of the stock tends to increase over the time. More mature companies, though, that do not grow as much as growth companies, happen to pay higher dividends. Most dividend payer companies do so consistently, for example, per month, per quarter, or per year. There are also some other companies that may pay dividends occasionally or irregularly. So what is dividend yield then? A dividend yield is a ratio expressed as a percentage that shows how much a company pays its shareholders in dividends relative to its share price. As an example, if the company paid $1 dividend in total in the past 12 months, let's say, and the current price of the share is $10, then the trailing 12 months dividend yield is 1 divided by 10, which is 10% for the company. Dividend yield can help investors evaluate the potential profit for every dollar they invest and judge the risks of investing in a particular company. A good dividend yield varies depending on market conditions, but a yield between 2% to 6% is considered to be ideal for most dividend investors. Probably worth to mention, higher dividend yields do not always indicate attractive investment opportunities, because the dividend yield of a stock may be elevated as a result of a declining stock price. With other words, since the dividend yield is calculated based on dividend payments that took place in the past, it may be misleading if the share price of the company is declining, which will then inevitably give an unexpectedly high dividend yield. Just for the sake of example, the ticker that we see at the top of the list will give dividend, and the pay date happens to be 26th of October, and the ex-dividend date happens to be 3rd of October, which means that in order to be able to get the dividend payment on 26th of October, you need to pay the stock. You need to purchase the stock before the 3rd of October, and you should be holding the stock on the ex-dividend date, which is the 3rd of October. And the dividend amount happens to be $0.21 for the stock, and the dividend yield happens to be 0.68%. We'll talk about other things that we share in the screen in another episode. Thanks for listening, and see you next time.